Hello guys, Steven Dexter. Welcome to this video. So today we're going to talk about all of the plays between July and August. There's tons of bankruptcy plays that produces profitable trades. There were some traps as well. So especially how to really avoid all those traps with those multi-day runners. We're going to take a deep dive into it. Make sure to click the like button and subscribe. Let's get into the video. All right, the first two multi-day runners that we have is YELL and TUB. So let's take a look at YELL first. The extension comes from 60 cents to $5, so the overall extension is close to 1000%. There were some support and resistance levels that I want to point out. So this one ran about 2 days in total, and it parabolic on the second day of that massive support. August 1st, traded about 200 million shares. That means there were 200 million support that consolidated between 2.8 to 3. And whenever you are shorting a multi-day runners, you do not want to short into support. So going to the potential red day, that the stock opened, I think, traded around 5 to 4 million shares in the pre-market, and it's not going to exceed all of the 200 million shares that was traded yesterday. That also means the stock is likely to lose liquidity throughout the day, and it's probably going to drop. And here comes the conflicting factors, because you have this massive support between 2.5 to 3.5, and you will never know when the stock is likely to bounce into this fade, because there's all types of support between 2.5 and 3.4. And shorting into this day, it means you are shorting into support. And there's a very good chance that stock can instantly reverse in one candle, something like this, from 2.1 to 3.4. All your profits will be gone if you are shorting at open. Whenever you are running into these type of multi-day runners, my recommendations is do not touch it at all, because if you are fading into support, it's very difficult to fade through high density support, which is above 100 million. That volume is traded into a consolidation. YELL on the first red day, not tradable. Now going into the second day, typically that shorting after first red day, it is a very profitable trade. And in this case, it's not really, because it gapped up into 3.4 and it pushed back down again and did exactly the same thing compared to yesterday. Bounced from that support, went all the way to 4.4. And typically whenever you want to short into a push from heavy support, the extension has to be around 60% or above. So if you mark the support is around 3, then it needs to push to 4.8 before it's shortable, and it did not produce enough range. And also there's not enough resistance around 4.6 or 5. There's only one failed parabolic right there. So going into this day, still not shortable. There is some resistance that was formed between 4 to 4.6, and it consolidates throughout the entire day. Traded about 30 million shares. So total shares traded between 4 to 4.6 is 120 million shares. That's around times 4, that's around 480 million to, I would say, 550 million, in that range. The dollar block that I've been tracking for pretty much all of the multi-day runners, but I do not think YELL is not very reliable, since there's massive support around 3. So going to the following Monday, which is going to be next week, I do not think this one will fade through the support, and it will probably do fade 3 to 5% each day until it slowly cracks that 2.5 support, which is the final bottom. I do not think it's worth it. There's a much greater chance that this one could bounce back and take our profits. That would be TUP. This is more of a long opportunity than shorting. I'm not even going to be surprised if this one push back again and breaks 4.4, then we go up even higher. And let's go through TUP. This is also another bankruptcy play. The extension is between 70 cents to $6-ish. You can see that as a multi-day runner, the criteria is the stock needs to go up consistently 3 days in consecutive candles, and each candle has to trade more volume compared to the previous one. So if you count July 26th, 27th, 28th, on the 28th, it needs to trade more volume, 200 million, and it turns out it didn't. It did a very small red day. Going after that, push through that red candle, and we go up even higher. And then once it performed the first red day, going to the following after first red day, then we had the news that pushed in after hour. This one is doing refinancing. This ticker is resistance and support is pretty much everywhere. Let's take a deep look into the intraday charts. We started to spike around 70 cents, extension 800%, spiked it to 5.6, And you can see that we formed a massive support around 3. On this day, July 27th, traded about 200 million shares. And July 28th, traded about 100 million shares. Once the stock breaks through that 3.7, there's a total around 300 million support, and the stock never dropped. It spiked even further, went all the way to 5.6. As I said, for the stock to become shortable again, it needs to spike 60% above the support. Now let's take a look at the support. It started to really spike around 3.6. So if you're using 3.6 times 1.6, that's close to $5. Once it consolidated between the $5-ish going into the first red day, still, this is not very tradable. If you take a look at the entire bigger picture, first of all, it traded at 140 million shares between 5.3 to 5.6. The total dollar block is around 500 million. But if you're using the dollar block and consolidations to short into a multi-day bouncer, you want to take a look at the support because you do not want to see multiple bounces because it's going to be frustrating and the profits is not going to look very good, and also it's likely to shake you out as well. There is support around 4.5, support around 4, then support around 3.7 and 3. And you can see that on each level, it is bouncing from the support, bouncing in the pre-market, bouncing in the midday, bouncing in the end of the day, and it's also bouncing after first red day. So that's where you have to learn how to take profits, especially if you're shorting the first red day. Whenever you are looking at multiple support, layers of support, those tickers are very typical to short into. And even though going into the next week, chart is not going to be clean anymore, port everywhere, not recommended shorting going into the future. Let's talk about the profitable plays. First one, we have MF. This one, extension is about 400%, spiking around 40 cents. It is gapping up in the after hour, and the chart is pretty much very straightforward and clean. It had consolidations around 2. Typically that we want to see 60% above the consolidations, which will be, let's assume it's 2 and 60%, so 3.2 at very least going to Monday if it wants to become shortable. Total of 100 million support that's formed around 2 as well. Going into the next day, the stock needs to trade more than 123 million shares. That's number 2. Number 3, because typically that we're looking at multi-day runners, there is a difference between multi-day runners. First one that we saw is 3 consecutive candles that each candle's volume has to be larger than the previous day volume. When we're looking at something that's going massive parabolic that has gaining 300-400% in one day, typically these type of tickers turn into multi-day runners, but they typically only last between 2 to 3 days. Not going to be last like 7 days like YELL or TUP. Each day they only spike about 30%. When the stock speeds up like that, MF spikes 400% or 100% in one day. If it spikes 100% on Monday, this will quickly become shortable once it forms consolidations, and make sure that you are not shorting to a support. So for example, if it gaps down on Monday, let's say opens around 2.3, then it's impossible to short into MF because you do not want to short into support. Typically, $2 stocks are difficult to short into. There's another example. You can take a look at the reference AHI. This one is very similar to MF. And this one did a reverse split. So I think it spiked between 30 cents to $3. And they had a massive parabolic on first green day, formed consolidations on the second day, then the major drop is on after the first red day. The only difference between AHI and MF is AHI didn't form a consolidation like MF. So shorting into MF, you have to be much more careful compared to AHI. A very similar chart, go ahead and take a look at it, use this as a reference. There is tons of opportunities. Even though we're in a bear market, rounding into all those bankruptcy tickers a lot more often compared to before. IPOs and the bankruptcy plays that turn into multi-day runners, very similar to Hertz that we trade in 2021. That'll be all the tips that I can give for now in this video. And if you have any questions, make sure to leave a comment below. Other than that, make sure to click the like button and subscribe. I will see you guys in the next one.